Hey everybody, I'm here with Jim Sackerson at Granada House, Kyle Polinick. We're going to talk a little bit about what we have just released in the newsletter Monday.
Yes. Let's do
Jim, catch me up on what is happening with the Fed's efforts to curb inflation, and let's talk a little bit about this soft landing.
that. Sure. Yeah, the old proverbial soft landing. So the soft landing is by definition when the economy can avoid recession and still curb inflation. So right now, we all know that the Fed has been solely focused on inflation and this 2% target rate, which may or may not even be relevant anymore. That's a different discussion. But they have seen inflation slow down significantly, and yet GDP and overall economic growth has continued. So if we can curb inflation and continue economic growth, that's what the soft landing is. And historically, it's been very hard to achieve. There are a handful of times that's happened.
However, the latest news says that we're achieving it. So are rates going up? Are they going to go up any further?
There is a chance that rates may go up more this year. We initially, over the last few months have been thinking that we probably were near the peak, but the one Fed board member this week said just because we take a pause at the next meeting does not mean that they won't be another raise this year, but likely one more at most.
Okay, one more raise perhaps, and then how long is it going to take before we can start to see rates coming down?
That's a great question, and obviously my crystal ball is as foggy as everyone else's.
That was a money question, everybody, and just couldn't deliver.
Yeah.
Just got to go get that crystal ball, I guess.
So what smarter minds than I seem to be indicating now is that longer-term rates may stay at these elevated levels longer. Now, let's keep in mind, too, historically, 7% isn't that high. 6% has kind of been the average for the 30-year fixed mortgage over the last half century.
We also, so there's an interesting topic about this inflated yield curve. So what that means essentially is that short-term rates are supposed to be a lot better than long-term rates, and they are not. So why and what opportunity do short-term rates potentially flipping back to where they should be will arise, do you think, when it comes to mortgage products? Do you think we're going to start seeing ARM rates back in the picture? The newsletter kind of indicates that there's people chattering about that.
It seems that the inverted yield curve, which typically happens when a recession is impending, now that it's likely that maybe we're not going to have a recession or it's going to be mild, we should see the inverted yield curve tip back to normal, where short-term rates are better than long-term rates, which means that ARMs, adjustable rate mortgages, will hopefully be a product that homebuyers can use again, because we haven't seen them really for over a year now.
So how does that change those dynamics? Are you thinking, when you're buying a home, are you still thinking, oh, I better get that good 30-year fix that I need? Or like, are you seeing like in our advising in what people are going for with their strategy, are you already seeing that home buyers are not going into home purchases with a long-term prospect on the rate they're getting, or how does that?
I think it's definitely become shorter term, because we certainly anticipate in the next 3 years, let's say, that long-term rates will be lower than they are today. So the opportunity to refinance is going to be out there, we think. So if someone's getting a ARM, let's say in the next 3 months, when ARM rates do maybe start to come back down, there's going to be hopefully an opportunity to refinance them into a longer-term mortgage.
And how long do people normally stay in their loans anyway? Are they
the
staying in their loans
average,
for 30
I believe,
years?
well, we're going to see this change now, because obviously we had a wave of people that have 3% and sub 3% long-term rates. But historically, the average mortgage is paid off every 6 years if you look back over like a 40-year period.
So the ARMs may be back in play soon. Maybe.
We hope. Yeah, they're not
and
yet.
If they are, that will definitely be something that we'll be looking on.
Absolutely.
Toward
Yeah, and that's kind of the silver lining to this soft landing, I think.
Okay, so let's just finish up with, what advice would you give right now for potential buyers who are waiting for rates to drop. I don't want to buy a house right now. I've heard this
We've all heard it.
from plenty of clients recently. And what advice would you give those people?
I would give them the advice that if they find the right house and the payment is palatable right now, to go for it, because there is a cost of waiting, as we know. Inventory isn't likely going to increase a lot, and we don't think long-term rates are coming down. So if people are waiting for rates to come down in the near term, likely not going to happen. They could miss out on the next,
waiting 2+ years,
waiting a long time and missing out on potential equity.
And then paying much more for the home.
And paying more for their home.
And I heard
this
quote that, and I kind of like it. Marry the house, date
the rate. Yes, we like that quote, and I think it is fitting for.
So your interest rate doesn't have to be a permanent. It doesn't have to be looked at as a permanent.
Not at all. Not at all.
And then with other products like 2-1 buy downs back in the mix,
which was in our last newsletter,
and
for anyone that read that.
Other options where choosing like a higher rate on the rate stack, for example, lowering closing costs.
Right, that's a great strategy.
You can plan for your refi, right?
Absolutely, yeah. Good mortgage planning and advising up front can save folks a lot of money in the long term.
I have to say, I was hoping by now we'd be back in the low 6s at least, but
we were all hoping for that. Yeah.
By the end of the year, if we're in the mid 6s, I think that'll make a lot of people happier. But at the end of the day, where do you think rates will settle? And say, let's just fast forward 5-7 years. Like, where do you think what range do you think we'll be bombing around in?
If I had to guess, I think that for the end of this year, we're not going to see rates coming down. Maybe we'll see rates come down in mid-24. And then I think if we hover in that 6% range, that's a healthy interest rate. It's obviously not as low as what we were accustomed to for the last couple of years, but I think that was artificially too low, and that caused some of the predicament that we're in now. But yeah, if we can hover in that 6% range over the next 3 to 5 years, I think that's healthy for the housing market.
So takeaways: don't set your sights on a 3% loan anymore. Know that you don't have to fix a 30-year rate when you buy your next home, and make sure you're asking about all kinds of loan products if that yield curve flips back around.
Absolutely. There's options.
Thanks again. We'll try to do more of these videos for you. Hopefully it was helpful, and we'd love any feedback you have.
Yeah. Thanks for watching.
Thanks, Jim.
Thank you.